All right, welcome back. Let's kick off Monday. This is going to be our first one of 2026, and we got a special guest. We got Justin Cambra, W2 to Freedom. So, morning, fellas.
Morning.
Good morning. Happy Monday.
Yeah, so what I like to do every Monday with Cody Davis is we kind of review his videos that he went over the week before. So for a lot of you, Cody does videos Tuesday and Thursday on his channel. And there was one that really caught my attention. And I think Justin had a chance to look at it, but it was kind of the mistake that may have cost him years. So, Justin, did you get a chance to look at that?
Yeah, I watched both of them this morning while I was on the Peloton.
All right. Do you got any questions off the top of your head before Cody kind of digs into them a little bit?
No questions. They were just great videos to make me think, and quite frankly, although we're probably 25 years apart, it's very similar paths. Actually, Cody's ahead of me. I'm in the end of year 2 of cleaning up. And just like how Cody got married last year, I'm getting married this year in 26. So it's one of those where trying to clean everything up, make sure we're all on the same page before we unite as one. So it was great educational stuff for me to listen to.
Well,
Congrats, man.
congratulations.
Yeah.
That's exciting.
Yeah.
So Cody, let's dig into that video a little bit because I really think because a lot of the calls that I jump on in the school community, the accountability calls, I think that's the biggest hurdle people have is they think they're making a lot of mistakes and they don't really see other people talking about it on social media. So it's always hard for them to relate. But you're very transparent about it recently. So maybe dig into that video and where was it because of the end of the year was coming up and you were thinking about things and your next goals, but how did that video come to play?
Just the making mistakes, like the biggest ones that I made, or
yeah, the biggest mistakes one first. We'll go over that.
I was just thinking about because I overcame getting out of partnerships, and I got out of a lot of my best deals and my worst deals last year to simplify my universe. I sold out of partnerships. And so I was reflecting and I was thinking, you know what, it'd be good to do a little video on this and share some of the mistakes, like giving up equity before you have to. That's a mistake. Doing 3-year debt products or shorter, another mistake. You can build a great business, but if it's short-term debt, that business can go away. And so I had a cool property. You'll have to visit sometime. It's on the Hood Canal, 7-bed, 4-bath, 4,200 square feet, waterfront. But it was a 3-year debt product. So even though it was cash flowing, I had the 2 worst problems in my business. I had partners that wanted bought out, and I had a 3-year balloon that came due when interest rates were much higher than they were when I bought it. So mistakes were made, but it was fun to reflect on those 2 mistakes on one deal. And so I was like, you know what, I'm going to put a video out there, and so here we are.
Justin, you have any questions before I have a few? That's why.
What's interesting, you had mentioned that you gave up too much equity too fast. And I'm not sure if it was your very first deal or what deal number it was, but for me, I think it was my 20th property where it was my first partnership. And I'd been talking to everybody about investing. And then one guy was like, man, we'd love to partner with you. I was so excited that just like you, they brought in the money and they were 50%. But I was doing all the work and I had 50% of the money, right? So in hindsight, like I was just so excited that somebody would want to do a partnership with me. In reality, I was just like you're saying, gave up a ton of the equity that I probably didn't have to in the grand scheme of things. So the lessons learned as you are building out your portfolio and learning the ropes.
Yeah, I think that's the one thing. I think a lot of people hear you talking about you kind of cleaning up the portfolio from the partnership side, but I think people haven't heard too much maybe about like the short-term debt. Like I think you mentioned that in the video, and even kind of just not taking on too many. I don't know if projects was the right word, but taking on too many things at one time. So maybe we can dig into that a little bit more, like the short-term debt. And I don't know if that affected Justin at all in his journey, but how did short-term debt come into play, and what were your thoughts maybe when you first were getting it, and then like you said, I think you paid the stupid tax. I think that's what you may have said, but so maybe talk about that, the short-term debt.
Well, it's just about managing what you have to do versus what you can do. And when I got started, I signed up for a lot of things I had to do. I didn't take the partnership route getting started. I borrowed my down payments in second position. So for those who don't understand that, I basically did 100% debt. Kiyosaki talks about how he bought his $18,000 condo and his down payment was on a credit card. That was 100% debt. I didn't put it on a credit card, but I probably had a similar interest rate. The down payment that I borrowed was a 1-year note. And what you find to be true when you do 1-year notes, 2-year notes, 3-year notes is that the borrower is slave to the lender. Like someone in the comments said, Ramsey mentions that you have to perform. Whoever holds the gold makes the rules. And if you are getting control of the gold for only 1 year, you get to make the rules for 1 year and then it goes away. The game ends. So it's just a dangerous business to play. I started doing that. So I got a 30-year fixed rate mortgage, no balloon, on a 12plex, and then the down payment was 12% interest for 1 year. And the 1 year ended. I thought I was going to be able to earn the money. I didn't. And so I had to beg for a 1-year extension. And by the end of that year, I was able to pay it off. But that's only because I scaled up and I had done another 12plex, another 6plex, 100% debt both times. And that's just a dangerous game to play. I'm not sure if Justin's done any 1-year loans, but on long-term investments, it's a bad idea.
I've done multiple, ranging from 1 to 5 year debt structures. Most recently, for a development deal, I had 2 1-year notes, and then just like you're saying, the borrower is slave to the lender. So the debt structure was set up such that if I didn't pay them back, there would be an extension fee. And these extension fees end up adding a lot. Now, the borrower ended up making, gosh, I want to say it was around 15% on their money. But, that knowing that debt was out there, and the closer it gets, the more that it starts stressing you out. And so, if you're doing these types of short-term debts, is having multiple exit strategies. So, or having a lot more liquidity, right? So, and similar to what, listening to Cody's, building up versus out. When I was building a bunch of stuff up at the same time, when everything's going well, no issues. But at some point in time, and when the market shifted and interest rates went up, if you have a lot of these deals coming due all at the same time, that's where the mass amount of stress comes into play. And that's what forces you to have to make up money somewhere. That could be selling properties, that could be making more active income, that could be flipping projects. And I've done a little bit of all that to get through the short-term debt and paying that all off.
Have you gotten out of all your short-term notes?
No, I still have 1 short-term note left. So, and I'm looking at taking another short-term loan to pay off at better terms than the existing one. The existing one has extension fees in it. So I want to get something in without extension fees to help alleviate some of that pressure. The goal here, and I'm sure you're the same way, Cody, is that the private money's debt needs to be paid off, right? Because you only get one chance to have a perfect record. So my goal here is to pay everybody off. And the last one I did, and this is like Cody was talking about, when you're trying to get these big chunks of money. I think you called it the equity play or something like that. The last one I did, I actually had to bring money to the close. So imagine selling a property and not getting paid, and you bringing money. I had to bring $25,000 to the table to pay off the private money lender. So this just goes to show you that you can make a lot of money if everything goes your way. But if it doesn't go your way, you still got to pay the money back.
Yeah, the capital gains approach versus a cash flow approach, right?
So I put, we'll talk about it more towards the end maybe, but I put Justin's YouTube channel and Instagram, so you guys can also go check those out. He is streaming also, so go subscribe there. But Brady Morgan's here, and he's been tuning in quite frequently now. I know he's coming out. He's working on like a book also on investing. He mentioned it was a strategy that no one's talking about too much right now, or hasn't talked about. But he does have a YouTube channel, so I also put that there. So go check him out. But he says, I got stuck in a hard money loan when the pandemic hit because the banks tightened lending for a bit. He said that was fun. So has that impacted you guys in any way? Like, did the pandemic impact any of your guys' loans, like Cody, for you?
Well, I wasn't qualified to get bank loans then, so it didn't change my business model. I mean, back then, that's when I was getting into a bunch of my deals. When everyone was pulling back, I was pushing in, and I bought most of my properties from 2019 to 2024, and I think I got my first bank loan in 2023, and that was a higher rate. So I didn't get to experience any of those low rates. Luckily, that might have messed up my whole business if I had gotten access to that and started.
You, Justin, did the pandemic or anything impact any of your financing or loans?
Yeah, so I used to do a ton of loans with U.S. Bank commercial loans. Commercial loans being short-term in nature, so typically they're 5-year fixed with a balloon. And at that time in 2020, gosh, I want to say I had in the teens, probably 15 commercial loans with U.S. Bank. At the same time, I was under contract to buy some properties in literally was like March or April of 2020, which is when COVID hit. And then all of a sudden they're like, hey, you've got too many loans too fast, and we don't want to do any more loans. I'm like, well, you guys already approved these loans. We're closing like in 2 weeks. So I had to kind of go over to the US Bank Wealth Management Group and say, hey, your commercial group is trying to cut me off. Like, hey, I have a ton of business with you guys. These need to close. So they ended up closing those 2 properties, and they basically said, no more, you're cut off. And so then I switched to other credit unions after that point to continue to buy.
I was gonna say I haven't done any short term, but then I thought about it. Me personally, for none of my property, but I did invest in a syndication when it was all the hype. And now that I think about it, that's what blew the deal up, and that's why I basically lost all my money for the syndication I invested in. But and Zuber talked about that on, he basically laid out why the syndications, a lot of them were gonna blow up, and it pretty much followed that path, right? A lot of operators knew, everyone thought money was free, everyone got in, thought rents were going to go up this much every year, and all of a sudden rates went up very quickly, and the short-term debt blew up in a lot of people's faces for these new operators. And yeah, so that was good. Like I said, like Cody says, a stupid tax, maybe, right? You don't know what you don't know, and chalk it up to a learning experience. Flavio does say, oh, go ahead.
Quick item on that is that we still, I mean, the syndications have been unwinding, and there's a lot of people that have been losing money. I'm surprised it's not as pronounced. And if you think about it, 2022 is when the interest rates started going up. And, almost all those syndications are 5-year fixed. Now, we're in year 3. Even if you perfectly timed it right the last in 22, your window of refinancing and making it through is narrowing every day. So like, if these rates don't drop down by the end of the year, there's a ton more people that are going to get crushed in all this. So whether that is giving the property back to the bank or doing cash in refinances, a lot more pain's going to be coming if these rates don't drop.
Yeah. Where was the one? Oh, yeah, go ahead.
I don't know if I've ever told you guys my double hard money loan experience. So I bought a 6 unit, and I bought it because I wanted it, and it day one, it was not financially driven. This was solely a long-term play. I did get to the finish line, but I got a hard money first on a 2-year deal and a hard money second on a 2-year deal. And I bled that deal for 2 years until I had to do a $140,000 cash in refi.
Yikes.
Awful. But it did work. And now it's one of my favorite assets. But that could have gone absolutely awful.
Doesn't sound fun at all. Flavio says, I do 3-year balloon payments. So he and a scary emoji, I guess. So is there any maybe suggestions if someone does a lot of 3-year balloon payments? Like what would, not advice I would say, but maybe what would your thought process be on it?
For 3-year balloons, Flavio, I wouldn't do it. I mean, for one, you have residential properties. Definitely wouldn't do that when you can get good products on a 30-year AM or a 40-year or DSCR loans with some interest only. You are starting to jump into commercial. You're looking at buying 10 plexes, 12 plexes, 20 units. It would be unwise to start out your first deal with the short-term debt product because you're going to know the least amount of information going into that. If I were you, I'd shoot for a 10-year where you're probably going to get 5 years for fixed, and then it'll adjust, and then it'll fix for another 5 years. That's what I would do if I were you. A lot of lenders will offer that. And at the 5-year mark, you don't have to refinance. It's just the payment will adjust one time.
Justin, any thoughts?
What we're, both Cody and I have experienced a lot. The good and the bad with borrowing money. So it's like now in today's world, and Zuber talks about having no alligators. If you can get something that cash flows long term, the longer the debt, the better, right? My only caveat to that is like, if you look back day one, if you're limited on options, when you start out, and I think Cody and I both did this, you're willing to take more risks out of the gate. If that was your only one, and it wouldn't take down your whole business or personal life, maybe it makes sense to do it. Because like at some point in time, you have to take risks. The more calculated risk, the better. But the last thing I'd want people to take some risks to get into the game, as long as it's not going to be so big that it could take you down. So like, as I look at when I built my portfolio, I was buying a bunch of these little properties, right? I'd say towards the beginning, 60 to 100,000. No one of those properties was going to wipe out everything, unless all of them had issues at the same time. So if you can take the calculated risk, get in the game, learn and improve over time, and if you have active income that you can increase, that helps decrease some of the risk for you.
And I'm not sure if this played any role in it, but it seems like, Justin, I know you've touched on it. You're kind of maybe cleaning up your portfolio a little bit, and Cody has also touched on that. And Cody recently got married, and you just said you're also getting married in 2026. So you think that has played a role in maybe you looking at your portfolio any different? I don't know if that was Cody's reason also too, but do you think getting married played a role in it?
For me, 100%, because I wanted to have where it's much more stable, right? And the other thing is that the end game is that you want to spend more time with the person you're going to marry, right? So my fiance, she's still working a W-2 job. So for me I'm trying to build up to where I can give her, if she wants to keep working, great. But I want to give the option for her to get out. So I was going, doing the equity play, building up, trying to stack up as much cash as possible. Now I want to get more into the conservative cash flowing on a guaranteed basis, such that it gives her the flexibility to leave the W-2 world.
And Cody, for you, did getting married or planning for that, did that have any impact on you looking at your portfolio any different?
For sure, right? I mean, there's 3 sides to the coin, and I was operating on the edge. I like to look at both sides. And I was playing with F.I.R.E basically every day for multiple years, which is fun because you learn a lot. You don't learn as much if you're playing super conservative or if you're all the way on the risk side. But like I look at it as I'm doing super conservative stuff. I'm doing super risky stuff without spending the money to get educated. I like to be in the edge of the coin where I'm spending a bunch of money, a bunch of time investing into learning how to play with fire. So I acknowledge that it's stupid, but I'm going to be as intentional. Like if you're going to be dumb, be smart about it, right? We've talked about that before. So that's how I was operating my life for half a decade. And that doesn't really work well when you add someone else who doesn't come from that background. So now I'm taking what I learned and reapplying it on more of the fixed benefit structures, like looking at seller financing some of my positions out to get a fixed income so that I'm covered. And then the play money goes towards doing the nicer, newer, bigger properties without partners.
So good morning to Frank, old guy REI. He says, aloha from aloha from lovely Watsonville, California. My two favorite youngsters, and he wants to reemphasize two favorite. I think I know which two he's talking about. But yeah, I think Cody, you even touched on it on your recent video with Zuber, and maybe people aren't aware of it or haven't seen some of your videos, right? You've been talking about how you were under so much stress that you were bald, right, for a period of time on some of your videos. And I think even so I go through the comment section and there's people that want to know what you're taking to make your hair grow, because I think a lot of us may want to try it. But there was a point where you were very stressed, right?
Yeah, I still take it. I mean, it's right there on my counter. I can grab it if you want, but it's just a vitamin. I don't like messing with hormones. So, but I was very stressed. There was a lot going on, and I wouldn't change it either, because the takeaways I basically got to fast track a career of mistakes into half a decade. Not a career of successes, but a career of mistakes, and that is terrible. Wouldn't wish it on anybody going through it. But you get to the other side, and it's like, oh, I understand a little bit more about what to do if this pops up, or how to structure this, and it allows you to fix certain problems in your business that I wouldn't be able to fix otherwise. So wouldn't change it. Yes, my hair did all fall out. I like to say my YouTube is a hair loss journey, because I kept posting every week regardless.
Yeah, I mean, people should go back and check those out. I mean, if they're not, like I said, if they're not aware. I mean, I picked up on it and I was like, wonder what's going on there. And then right after that, I think you kind of started talking more about kind of transitioning your portfolio and maybe cleaning things up. But Flavio is asking Justin, he says, talking of mistakes, Justin, can you touch a little bit on that sidewalk to nowhere project you got going on?
Yeah, the sidewalk is done. The city signed off on it, so now we're in the what's called the final short plat. So, which basically says there's like 8 things I had to do. All 8 things are done. They're sitting in the queue. Now I'm just waiting for Pierce County to approve it, at which time that one lot will now be split into 3, be able to sell the 2 existing houses, and then I'm going to build on that 3rd lot.
But the sidewalk still goes to nowhere, right? Or it has a purpose now.
Yeah. Since the last time I was on, it actually got worse. So it was the sidewalk to nowhere. And then as they're doing the asphalting, there was the engineer measurements were not perfect. So, I'm learning this as I go. The slope from the crown to the sidewalk needs to be 2 degree. And so there wasn't enough slope for the water to run off the road. So to try to fix it, they being the on-site, between the on-site inspector and on-site engineer and the asphalt company, they're like, well, if we grind and overlay, which means more money, the shortest way to say that, And so they basically did more asphalt further across the road and more. So there was another that cost me another like 10,000 at least. And I'm just like, oh my God, and the other day I called and I was confirming with Pierce County. I was like, there's a prelim and then there's the final short plat. So on the prelim, I get a hold of the engineer and I'm like, hey, I'm just making sure you guys saw like all the forms are in there just to close this one out so we can move to the next one. And then the guy's like talking to me. He's like, looking at this, if I was you, I probably would have pushed back on that sidewalk. And I was like, I was so pissed. I can't. Are you kidding me? Like,
The city made me do the same thing
yeah,
back in 2020, and I just told them no, and they said, "Well, we made an agreement with the prior owner." I was like, "Go get payment from them because that's not me."
right.
And eventually they went away.
Yeah, it's one of the. Did you get your permit approved though?
Yeah. I mean, I had no issues doing any of my projects on the actual property, but they paid and put in the sidewalk and they put in a retaining wall. They actually killed one of my trees in the process too.
Dang.
But I got everything done because I had to actually go through and redo all the electrical panels and I had to redo a bunch of plumbing and had no issues.
Yeah.
But I had to push on them for a long time for them to go away.
Yeah. Hindsight being 2020, like if you're doing a project and it's like that, and I thought I had people that knew what they were doing. So I had like a permit expediter and I was like, can they make me do this? And I'm like, well, if that's what they say, and I'm like, okay, I guess we got to do this thing. But now it's like, okay, we should push back on all these as much as possible, right? How you get it done, I don't know. I'd have to find another expert to see how to push back and not end up doing it because that literally probably cost me at least a year. Gosh, at least 100,000, right? And stress to the massive amount of stress, right? So Cody had hair loss. For me, it's like, when I'm not stressed, I'm doing a routine, I'm able to stay fit. When I'm stressed, I get out of routine and then I start gaining weight. So it's like that's been my biggest hang up with that whole project, the level of stress. And it's still causing me stress today until that thing is done because I lose money on that every month, like 6,000 a month. So, until that's done, it's super stressful.
You got my alligator beat.
Yeah.
My current alligator is only 4,900.
Well, up in last month, I got rid of my other alligator. That one was like 5,000. So, just think about like, and maybe you're the same way, Cody. When I think about when I close this Tacoma project out, the fact that for 2 years I was carrying over 10,000 negative a month to be able to survive through that just goes to show that when I'm out of that, the amount that I'll be able to increase in the future is like exponential.
Yeah, you cash flowed a lot negatively.
Yeah, we should always clarify that whether it's positive or negative, right?
I think that's the kind of stuff people like hearing, though. I mean, just that type of transparency, knowing that other people that have been doing well and doing this for more years than they have, or have struggles, or even like like my investing in a syndication, me losing all my money, and you folks talking about having alligators, and yeah, I think people relate to that a lot more. I see Ray tuning in. He says, I've always leaned conservative, playing it safe and often leaving too much equity in my deals. At what point do you feel becomes playing it too safe? Is there a number or percentage you go by? Sounds like getting married might be one thing too, right? Getting married makes you look at your portfolio differently. But Cody, is there like a number or percentage you may go by?
I like to get to the point in my portfolio where the equity is paying out 4%, whatever that looks like. So that might mean I have 35% equity in the deal. Might mean I have of 25%. I have 45%. I've got stuff anywhere from where I have 10% equity because I just bought it, 90% leverage, or where I'm basically 50% LTV. And I like to get to the point where it's 4% return on equity, but it's an infinite return. If you could get to a 1.5 debt coverage ratio, I'd say that's more important than a loan to value. Meaning that for every $1,000 a month of debt payment, you would have $500 a month of net cash flow. And that's not like 500 this month, and then I have a bad month and then it's zero. It's at the end of the year, you cash flowed 50% above and beyond your debt cost. That is more valuable than saying, well, I'm at 50% LTV or 80%, because there's people that are at 50% LTV that have a worse debt coverage ratio than people at 80% because of market conditions, stability, size, all that debt structure. So focus on the debt coverage ratio. It basically says if I have a 1.5 debt coverage ratio, it takes 2 months to save a mortgage payment. If I'm 1.2 debt coverage ratio, it takes 5 months to save a mortgage payment. It shows you your exposure.
Mm-hmm.
Any other additions to that, Justin?
You basically are describing Dion, right? Because I remember Dion was probably sub 50% leverage. And it really comes down to, like, with Dion's lifestyle, like, he was happy with that. He wasn't trying to grow it. He had enough income coming in, right? If you're trying to grow your portfolio, increase the cash flow, whatever you're trying to do, you know, if you have the cash, keep putting the new cash in. If you don't, you can refinance and then redeploy it. Now, if and when these rates do drop in, you know, you should probably restructure your debt at that time, pull some of the cash out, put it into like Cody's talking about, a higher return on equity, such that you can continue to stack up more cash.
Yeah, and I see Coach Nick tuning in. So if real estate is not the asset class you prefer, he has done real estate and he still looks at real estate, but Coach Nick is definitely into Bitcoin right now. So if you want to know more about that, there is his YouTube channel. So go check him out over there. He's putting out a lot of good daily content on Bitcoin, and he's my weekly Saturday guest now. We do a weekly Bitcoin wrap up. But yeah, janitor on fire says, yeah, so there's no way I could deal with that amount of stress. So I think he's talking about Justin and, you know, the alligators you folks had.
The biggest alligator I've ever seen that a friend had, like a close friend, was 300,000 a year negative. That's terrifying. The biggest one I ever had was, I think it lost like 180 in a year.
Dang.
But that wasn't just on operations. Operationally did okay. That was like continually doing CapEx month after month after month after month. And that's a lot of people don't understand. You can have a property that will debt cover and still lose a ton of money due to CapEx because they're different metrics. So you gotta be careful. Renovating too quickly can take you out.
I have a property like that in Wisconsin. It's it's related to constant turnover. You know, at the beginning I was like, oh, I love this property because it's 3-bed, 1-bath. But what ends up happening is when you have these bigger units, yeah, you can get more rent, but they tend to have kids. And when you have a lot of kids in an area, they're actually the problem. And so, you know, we go from literally in October, we were fully occupied. Life is great. And now we have 25% vacancy, 4-unit turnovers. And then the unit turnovers range from, depends on the last time it was turned over, 2,500 to 8,000. And so now we're having to do some owner contributions. This is one of the last partnership I have left. And so we're sitting here dropping in 8,000 a piece to fund this thing, right? And then we're coming up in January of 27 is our refi. Our balloon's coming up, right? Because it's 5-year debt. So we used to expense everything, and this debt is at 375, and you know now the the guy we had originally on it, he since retired. Now there's a new guy, and then they're doing their annual audits, and so now they're asking for the T12, and they're like, "Man, your DSCR or debt service coverage ratio is dropping low, right? Because we just been expensing everything, and then that we take losses, and then that helps from a tax. But now when we're going to refi, now we're shifting like for 26, we're going to shift all that from expenses to capex to help the T12s. The goal to then give us the option of be able to refi when we get into, let's call it Q4 or something. We got to wait because we need the rates to come down and then to refi.
Brady Morgan is saying elevation and grade issues can be tricky even for experienced contractors. As a building inspector, I have seen my share.
What's interesting on this whole thing, I go back to the engineer. I'm like, you guys did the survey. Like, how is there any chance for this to get screwed up? That's exactly what I pay you for. And it's like, they give me like a whole laundry list of what it could be. And I'm like, what I've learned in this process, and maybe Cody, if you have experience, is that when it comes to architects and engineers, they don't move until they get paid. They have zero incentive to move faster to help you get done faster, and they're very good at saying what they don't do and not hold. Basically, you being the developer are 100% accountable for everything, and so you always got to be like monitoring everything that they do because you have to protect your own interest and make sure that it gets done and audit what they're doing.
You, Cody, digging into more like new builds right now. Is that you would agree to that, or is that something you're seeing
Yeah,
also?
people are super slow. I've been trying to get a project pushed through forever, over a year, and I have to email them. Like that reminded me I have to email them because I emailed them a week ago and I didn't hear back. So awful. If I wasn't a real estate guy, it would be easy to go step into their shoes and do some studies and then just be the best in town because you actually respond to emails and calls and people like you.
Right.
The accidental landlord says he woke up to a cryptic company-wide email, all sites shutting down, mandatory 2 p.m. meeting to discuss next steps. One of those moments that remind you why building assets outside a W-2 matters.
Dang.
If all you had was a triplex, you live in one unit pays for the building expenses, and one unit is a fixed income, you could retire. It wouldn't be great, but you could retire. I know people that have done that. So it takes one. It'd be great to get more, but if you can get one paid off, you buy one, you do a couple flips, pay off the first one, you could be out within 5 years.
Yep.
I think the main thing there, and I picked this up on your video, is that you have to have low cost of living. So Cody and his wife are 4,000 a month. Cindy and myself, our travel can get high at sometimes, but for the most part, we have low cost of living. Like our rent is 1,400. Low car payments. We have old cars, right? So I think that's one of the things that Cody's done well and I've done well is like, yes, we've bought real estate and we've increased how much we make, but we've actually been lowering our cost structure as we make more money. So yeah, that one triplex, if you have low cost of living, then you could be set off 1, 2 properties.
Josh is saying, yeah, people always see the good sides when there's always so many costs behind the scenes. Those costs can easily add up to what some people make in a year. Yeah, I think some of the alligators you guys mentioned definitely, and even your, like you said, your friend, what was 300K they lost a year or something?
For a year, yeah, on operations and
Yeah.
debt. That's unfortunate. It's not like it's CapEx where you're like, all right, I can't keep doing remodels. It's like, oh, that's just to survive. That's unfortunate. But it happens, and it happens on bigger scales, like the syndication you lost your money on. Like, they were probably at a bigger scale than that. Josh is having fun right now with one of his rentals. and by fun I mean an absolutely terrible experience, because property managers, he's an out of area investor, and his PM hasn't filled his unit in months.
Mm-hmm.
Granted, we're in winter, which sucks, but it's mind blowing to me that they haven't found a tenant. So I don't know the solution on that other than find a new PM, but it's crazy.
Well, I think I'm not,
One
yeah.
item is that Josh brought up a good item, the secret expenses, right? And I'm interested to see what Cody's doing, because like one of them, for example, we have to annual business registration, right? So for example, in the city of Tacoma, I think it's like a couple $100 a year. Then my bookkeeping is like, I want to say 1,000 a month, because I have 3 states, 3 entities, and a partnership. So I'm interested, like, these are like the behind the scenes stuff. Yes, there's cash flow on the property, right? These are P&Ls for a property, but then you have your business, right? So you have your bookkeeping, you have your taxes, you have, there's a lot of these other expenses that pop up. Cody, what are you paying for bookkeeping, one? And then what are some of the other like hidden expenses that people don't realize?
Well, every LLC is like $1,800 to file.
Mm-hmm.
So that's something. And granted, I own some stuff in my name, which makes it less expensive. But my LLC is $1,800 to file. I've done all my own bookkeeping. I've hired, and I've tried referrals of good friends and prominent buddies in the space on a local level, and all of them sucked.
Yeah.
Unfortunately, the only common denominator in that situation was me, but I swear I was getting them everything, and they couldn't produce stuff. And then what they would produce was wrong. And it makes me wonder if what they were doing for these other people was wrong.
Mm-hmm.
Because having been through it, I've scrubbed through financials so many times, and the way that they're doing it is just, you try and give them perspective and then they do it wrong again. It's like, all right, I guess I got to go fix everything. And I paid you all this money. And I was at one point paying $300 a month per LLC, which sounds like a similar cost to what you're doing, but they still screwed it up and I had to redo it.
Right.
Hyder says, out-of-state PMs can be incredibly awful. We may have to sue our previous PM. They charged a 20% management fee and the work was not done. That fee needs to come back along with any damages accrued. Yeah, that's usually is the challenge, investing out of state. I mean, it is challenging, but everything has their challenges, right? And I think maybe we can move on to a little bit of Cody's video, also talking about kind of not getting distracted, not taking on too many projects at one time, and maybe it's because like this, going out of state, or you having difficulty with property manager, you start looking for other solutions, like maybe RV parks is easier, maybe Airbnb is easier. So maybe touch on that a little bit, Cody, from your video about why you recommended not taking on too many things at one time.
The small landlord that manages himself can make a bunch of money. The small landlord that is subject to a property manager gets screwed. And that's what I found consistently. Let's say you own a duplex and the PMs take even 20%. If the rents are $2,000 aside and they're making $800 a month, they're not going to do a whole lot of work for $800 a month, and the rents probably aren't that high. So the reason I say you shouldn't get scatterbrained is if you're buying a whole bunch of stuff, it's very difficult to get to that bigger level where the PM is actually going to take good care of the property, where the property can actually afford to pay for payroll and actually make the profit for yourself and the management company. If your gross rents are only $5,000 a month, and I'm saying only, like, I'm not trying to make that sound like a little amount of money, but if the rents are only $5,000, there's only $5,000 that could be paid out to the taxes, the insurance, utilities, maintenance, management, and yourself. Like, you probably can't retire on just that unless you're living lean, like we talked about earlier, and then you're managing it yourself. And so if I were to go buy the storage units, and I kept buying hotels, I would never get to the level in multifamily where I could get the 3, 4, 5% management fee and then have payroll and really step away. There'd be no way to get there because I'd be stuck on these other smaller, like I was looking at a 73 unit storage deal. It's too small for a manager. So I would never get to that level. And that's why I recommend, hey, just stick to one, pick one, because then you actually have a chance of getting to the bigger deals where you can walk away. And I feel like in apartments, it's probably about 75 units in my market. 75 units is about where you could really walk away and trust that the manager's going to make enough money to take care of the management.
Justin, any thoughts on that? Like, did you feel like maybe you got distracted trying to do different things, too many things early on?
Yeah, 100%. Yeah, because I was listening to Cody's video where he's talking about getting into a lot of stuff, and I'm guilty of the same. I'm like I like variety. I was doing a ton of stuff, right? And Cody's video is talking about building. Instead of, you know, I was going to the extremes. There's the Burj Khalifa, like massive expansion, and you're very vertical, right? That could topple over, right? And then, like, I was thinking about the Pentagon. Pentagon, I think, is only like 3 or 4 stories, but it's like massively wide, right? So in hindsight, like I wish I would have done more of the Pentagon approach, like more stable portfolio to begin with, and just focused on one thing. And then this past year, I went to Spain. It's called La Sagrada Familia. It's a massive church, but it's been being built, I want to say like 80 years or some massive number. And part of it is because when they're building it up, it's a bunch of spears all at the same time, right? And that's effectively what I've been doing: in state, out of state, short term, medium term, long term, development. And if I would have just stuck with like the core, and the more I hang out with Dion, I'm like, man, if I just did like 5 house hacks and self managed, I'd be in a better scenario, right? Because like we're talking about property man, I just did the rough math. I'm paying about 5,000 a month for property managers if you add up all of it, and it's one of those where it looks like a large number, but I have, gosh, probably 6 property managers. There's one that only does one, but still, that's like $250 a month. And you add all these up, and then they start becoming large numbers. So it's like, if all this was in 1 hour from where I lived, I literally could take it back over and have 5,000 more cash flow. Is it more work? Yes, but 5,000 in cash flow, that's a lot of money for a lot of people.
Do you guys think part of it is because people get bored with what they're doing? They try to diversify or do too many things, or do they get caught up in that whole idea of diversifying? So is it they're getting bored because what they're doing now and they want to try something else, or is it because people keep telling them they need to diversify for risk management reasons? So Cody, what's your thoughts on that?
Probably both. I mean, it sounds fun, and everyone's getting beaten into their head of you got to diversify. And personally, I wouldn't diversify till you're at like 10 million in equity. That's actually paying out, because 10 million, you could probably pull 400 or 500 grand a year passive, not managing the portfolio. So that would be my recommendation. That's what I'm doing personally. I'm not diversifying until I get to 10 million. So I have a few more years to go. And then when I get there, maybe do something else. But I probably won't, because if you can get to 10, you can get to 20. And you can also take yourself out by doing some stupid stuff. So then I don't know that I will diversify from apartments. I'd probably just put some money in stocks and different things like that.
Got to get more of that gold and silver, buddy.
I have some, but it's non-performing assets. They're cool. I only buy it because it's pretty.
Yeah.
It's not like it's an investment. It's insurance. I mean, it's outside of the system.
Right.
And the other thing is, it's not on my balance sheet. Like, what if you have money outside the system? Why do you want to tell people about it? It's my thought. So
My
it's just
my
there.
gold and silver is literally has always been the break glass in case of emergency. So and then I the last like what 30 to 45 days, it's like doubled. So it's like okay, you know, very fortunate that that's happened, but it's one of those things where it's hard to transact, harder than not as hard as like real estate, but like a stock, you can trade out of it quickly. But I like the gold and silver just as a you know ultimate protection to where if I do get into a massive amount, I do have enough to unwind if I needed to.
Looks like the property management discussion brought up a few questions. So Brady is saying, if you had a portfolio of only 15 long-term rental homes, would you self-manage or look for a PM? And then Cody Evers is asking, would you take it back over and then hire someone personally to help you so you don't have to do all the work? So I guess if you self-manage in the beginning, would you transition over at some point so you're completely hands off? So maybe you, Justin, because I know you have some out-of-state things, right? So what's
Mhm.
your thoughts on that?
For the out of state stuff, I don't think I'm ever gonna self manage that. For the local stuff, quite frankly, I've been thinking about, man, should I just do it myself? So I would be potentially open to doing it myself locally, but it comes down to like what kind of lifestyle you want to live, right? So um, if I keep stacking more and more properties, if I did self manage it, doesn't mean me personally. Ideally, I could hire somebody that I'm paying that would help manage that, whether they're full time or part time, to help me with that. But I could foresee like a couple years down the road, I could get out of all 1031 out, all of Midwest, plug it all back into 1 hour Seattle. That may be just one large building or a couple smaller multifamilies, such that I could do the management.
Cody, any thoughts on that?
Well, to Brady's point, he said,
Oh,
if I had a portfolio of, and he said only 15 long-term rental homes, would you self-manage or look for a PM? I would sell them and buy one. I'd rather have a 15-unit apartment building than 15 houses. My thought. And if you sell the 15 houses, you could probably buy more than 15 apartment units. So you could probably go buy 2 15 units or 3 10-plexes. I'd rather have less locations and then I'd put it in with PM. I don't like rental houses, and I have a few, and I own some out of state. I own some in Tennessee. I own some in Indiana. I own some here in Washington. I've done the out of state thing, still do, but I would trade those houses for apartments, and I'm in the process of selling my out of state houses, which are with third party PM. Sell those and go buy apartment buildings locally.
shoots, I skipped over this one. I want to bring this one up. I think this is from Cody's channel. Christopher Gallegos is asking, how can I determine how much I can afford for 2 to 4 units? So
Depends if you're
just,
an owner occupier or not. Is my point.
yeah.
Did you want to share, Justin?
Yeah, so if you had a client, let's say you had a client looking for a 2 to 4, how would you direct them in your market, Justin?
Well, like Cody's saying, if you're owner occupying, then it comes down to debt to income ratio. I want to say, don't quote me on this, but I want to say it's around 41%. So if you took all your expenses, including whatever this 2 to 4 unit you're going to buy, if you were making 10,000 a month and all your expenses was 4,000, that'd be a 40% debt to income, and then you could get approved. If you're doing if you're doing whether it's a conventional owner occupied or FHA owner occupied. If you're going to look for a debt service coverage ratio type loan, Typically, they're going to want to see a 1.25 debt service coverage ratio. That's kind of your standard. There are other stuff that will let you go lower, but I would probably stick with the 1.25 product. At which point in time, back to originally Cody was talking about, if you had $1,000 as a mortgage payment, a 1.25 would mean that you'd get $1,250 of income coming in. That would get you the 1.25 debt service coverage ratio.
And he follows up with, would it be too much to chew to go for a 10 unit versus 2 to 4 units?
No, I started with 12.
My first rental non-owner occupied was an 11 unit, and it's part of it was I didn't know what I didn't know, but I think what Cody's going to say is if you have more units, there's more. It's a little bit more stable to help you. If one unit's vacant on a 12 unit, that's what 8% or something like that. Versus if you have a duplex, one unit's vacant, that's 50% vacant. So there's that's one of the pros. Obviously, the con is probably more money to purchase than a 1 or 2 unit.
Well, and as an example, my buddy just had a fire in one of his duplexes. Both of his tenants left. I had a similar fire in my 12 unit, but because my 12 unit's multiple buildings, I only had one person leave. Even if I had all the people in that building on that side of the building leave and it was 3 people, I didn't lose 100% of my income like the duplex did.
Mm-hmm.
So you can have tragedies happen and still have more income coming in. So that's why I would recommend looking into bigger stuff. But if you're more researched on duplexes, it would be unwise to go buy a 10 unit until you do the similar amount of research on that type of building.
The one thing I just would say is always make sure, sometimes you may qualify for a property, but that doesn't mean you can afford the property. So I think Justin may have touched on, so you may qualify for this loan or this property based on what the lender's requirements are, but just make sure you can actually afford it with maintenance, CapEx, reserves, those type of things. Let's see. A lot of talk of silver in the chat. But yeah, maybe we can just we'll dig into Cody's. Well, let's see. Oh, it's kind of we'll dig into Justin then. Justin, what you messaged me before the new year wrapped up, right? And you kind of needed not needed my help, but you wanted me to hold you accountable for some things in the new year. So what is that all about, and what is the vision for 2026 for you?
So for me, I wanted to take there's 2 channels in specific. One of them being W2 to Freedom, and the other one is my real estate agent business, which is called Camber Real Estate Group. So the goal for these 2 is to build up the social media presence such that I hit 10,000 followers combined between the 2. So that could be 8,000 W2 to Freedom, could be 2,000 for Camber Real Estate Group. Those 2 things are going to help drive more business for me. Whether that is referrals or transactions for the agent team. And then a lot of it too is connecting with other people, learning and sharing with them. And in a perfect world, get more mentors like Cody's done a great job of. If I can attract more mentors to help get me from current level to the next level, that'd be huge as well. But to the point of why did I reach out to you? I am much better at getting goals done that I tell other people about or that I publicly post, right? So that was the whole purpose of it. Now that you know about it, you're going to be always bugging me about it, which is awesome. That's the reason why I'm doing it. And then, then you can help get me to where I want to go.
Yeah, very cool. Like I said, we can set up something, maybe try like how Cody, we're doing something weekly, get you on the schedule. And like I said, if those of you are tuning in, Justin has linked his channel. So he is also streaming on his platform. So go check it out there, subscribe there. I think you'll be in Vegas also. Cody is speaking. let's see, maybe one last. Max is here. So Max is asking though, would multiple small unit families be safer than an apartment complex when it comes to disaster and such? I think you kind of touched on it a little bit, Cody, right?
I prefer mid-sized apartments. I'd like to get to bigger apartments, but wants in one hand and haves in the other. So my average property size right now is probably in the 20 unit range, and I wish it was in the 50s to 60s. So that's my thought on that question. I would rather have bigger buildings that I own by myself. Like, all my biggest buildings are just me and my wife, so no partners. I wish I could have even bigger buildings like that, but that's going to take time.
Flavio's asking, Justin, when are you having your next event? So yes, I think you just had one recently, right?
I'm doing monthly meetups in the Seattle area. So the next one's actually, I'll be posting today. It's going to be next Monday, January the 12th, 6 to 8 p.m. in Bellevue. And the goal, we're going to talk about W2 to freedom, but then also with that is how you're going to work on it for 2026. And I'm thinking about putting in there, like for the people that show up, having a recurring meeting specifically with those people where I'm going to share my goals, you share your goals, we then track with each other. So in a perfect world, we have a huge turnout on that and track the progress for that cohort, if you will, all the way through 2026.
Very cool. Looks like you picked up some subscribers today. But yeah, so like I said, it's cool that you're live streaming. Hopefully, we can get that up by the event. And it's I know you're talking about too. So if people haven't got their accommodations set for Vegas, I know you mentioned the flights have doubled or something. You said.
Yeah, flights are crazy expensive. Right, normally they're like 200 to 300. They're like 6, 7, 800 bucks now. And so I'm like, I'm kind of into the point now where it's like I'm either going to buy on miles or see if I can get something right before, see if the prices come down right before.
Did you just throw out 6, 7 in reference to the cost of it?
Oh man,
I don't know
that's
if you guys.
I still don't get it.
Yeah, I don't know if you guys heard Dion. Dion said 6, 7 was I guess, word for 2025, and then 2026 is going to be the Quality Leering Center, or Leering is going to be the word for 2026.
Yes.
Anything else you guys want to wrap it up with today?
We had a question in the chat from Driven Addict.
Oh, that's right. I saw that. Where did it go? Let me see. Shoots, I did see it. Crap, where did it go? Dang, where'd it go? I did see it earlier.
It's not too far back.
Oh, no, that's not it.
It's in between Cody and All Nighter Hider.
God dang it, where did it go? Oh, there we go.
Yeah.
Yes. So Cody, would you sell a single family residence if you could net 20 to 30K and use that for a sixplex reserves that doesn't have any reserves at the moment? Oh, okay.
Probably, unless you believe that single family is going to go up significantly in value or the cash flow is really strong. Example, if you were cash flowing $500 a month or $1,000 a month, I probably wouldn't sell it to get $20,000 to $30,000 of cash because the return on equity is so high. And there are deals like that. With the no reserve on the 6 unit, if you're cash flowing really strong on the single family, I'd probably just get a 0% interest credit card for 15 months and put the cash in the bank. And if you end up using it, great, you needed it, and just pay it down with the cash flow. If you didn't need it, you could just pay off the card when it starts accruing interest. But I've done that before. And I wouldn't just sell an asset just to sell it. But if it doesn't fit your portfolio and you don't feel comfortable with the reserves you have, then sure, sell it.
Yeah, we'll wrap it up then with Nate Ray is asking, are you guys staying at the Downtown Grand Hotel? Is that where you guys are staying? Or I'm not sure if you want to say, but
I have to book my hotel still.
Me too. Yeah.
Well, just letting you know, then a lot of people are staying at the Downtown Grand, but I think the Grand and the Golden Nugget are the two places that I'm hearing most people are probably staying at. And there was one other January 15th, I believe Zuber said, is the last day for ticket sales. So if you haven't got your tickets yet, go pick up your tickets before he closes sales on that. And I believe he also opened up more spots for kids, teenagers to attend with their parents, I guess, as a guest. I think a lot of people want to sit down with Cody, so there's a lot of people attending that because I believe they get a one-on-one with Cody or a group session. But I think he's opened up for more opportunities for that right now. But yeah, definitely. Yes, Hyder. Driven's comments are, but I believe, are coming from Cody's channel. So, but yes. Yeah, everyone. This was a fun one. Like I said, I'll probably set something up with Justin. We'll probably get him more on a regular basis. Cody, always thanks for doing this on Mondays, and I will be back with Brandon. We skipped last week because of the holidays, but letting everyone know he also changed the name for his YouTube channel, so it's now Building Wealth Flows. He thinks people didn't relate to the B2R, the build to rent, so he changed his YouTube channel name. But everyone, thanks for tuning in today. Justin, thanks for jumping on. Cody, thanks for doing this, and everyone have a